I think one of the interesting things that's happening is that the fintechs, the new business models that are coming up with innovative ways of charging and of making money from payments. So good morning, everybody, and thank you for coming this morning. I'd like to say thank you for inviting me here today to make this presentation and to talk to you about digital wallets and the future of in-store commerce. First, for us at Ingenico, India is a strategic market. We've been present in this market for the last 15 years. I met with a number of our clients over the last few days at the stand, at the booth that we have here, and I've learned an awful lot about what's happening in payments here. And I'd like to thank all the people that came to our stand, who talked to us about payments, who opened up our mind to the possibilities of what we can do here and what we can bring from India to other markets. Because the market here is extremely dynamic, it's very innovative, and I think, and you'll see as I go through the talk I'm going to give this morning, you'll see how some of the ideas that I talk about we're seeing here for the first time, and that we can bring to other markets. So my talk this morning was originally about the future of in-store commerce, but because it's part of fintech, I'm going to concentrate on payments, because I think that payments are really an integral part of what in-store commerce is about. They're part of the in-store experience, and they're also part of the in-store experience that will change the most over the coming years. And I'm going to tailor my words to India, because payments are something which are inherently local. There's no point in me coming here today and talking to you about payments in Paris, where I'm from, payments in London, payments in New York. Payments are something which will always be local. And anybody who tries to tell you that payments are going to go global, payments will be international, everything will be the same, they really don't know what they're talking about. It's so tied into how local economies work, local regulation, local habits, and then just the speed of adoption. So you'll see as I come on later and talk about digital wallets, how what we would say in Europe is new and alternative is absolutely standard in a market like India or in other markets. First thing I want to say is also how in-store payments and in-store commerce is here to stay. Everybody likes to talk about internet commerce, how it's the next big thing, how it's super important. But in India alone last year, the number of POS devices grew by 20%. So it went from 4.6 to 5.5 million POS devices. So that's just to show not just that retail commerce is growing, but that digitalization of retail commerce is happening at the same pace. So I'd like to start. My slides here. I'd like to start by talking about that projected growth of retail and in-store commerce. And what you see on the slide on the chart here is the relative value of both parts of in-store and online commerce. Growth in Indian e-commerce is about 19% projected for the next 5 years. Growth in retail commerce is projected at 9%. You can say what you want about those figures. When I was preparing this, I found all sorts of statistics that put everything from double that on both sides to less on both sides. But the relative value is roughly that online commerce, e-commerce, will grow at about twice the rate of retail commerce. But just look at the absolute values. Look at the chart on the left and how big that amount is, and how big that amount will be in 5 years' time. And look at the chart on the right, which is growing. Sure, it's going to double in size, but it's doubling from a small base. So it's the law of big numbers. You start with a big number, you grow it by a small amount, you still get a very big number. So in-store commerce is here to stay. In India, we're talking about 1.4 billion in the next 5 years. 1.4 trillion, in the next 5 years for in-store commerce. And as I said earlier, that's going at the same time as a digitalization of that. So everything is coming together, not just an increase in commerce, but an increase in the way that commerce and that payment will happen. So all the venture capital money might be going into e-commerce and online, but the business, the real business, the value for the economy is happening just as much, if not a lot more so, in-store. And what most experts are anticipating is that as markets become more mature, as in-store commerce grows and as e-commerce grows, that it will flatten at about 3/4 in-store, 1/4 online. So that's our baseline, what we're talking about in terms of volumes and where we think things will happen. But the one thing that e-commerce really has done and that we can't deny and that is absolutely certain is that it's changed our expectations, both in terms of what we expect from a commerce experience and what we expect from payments. And put simply, what that means is that customers want more. They want more of everything. They want things to be more simple. They want to be recognized more for who they are. They want things to be faster. They want things to be to give them more choice, more personalization, and they want more efficiency. And what that means is that they want more than just a product. So when they go into a store, retail store, they want to not just to buy, they want that to be part of an overall experience. And that's where e-commerce and retail are coming together, in the sense that they create this expectation from customers. And one thing about that is that we talk a lot now about BNPL and buy now pay later, and how that is the next big thing in terms of in-store payments. But buy now pay later has been around for years. It's been around for forever in terms of credit installments, buying in credit cards, in-store credit cards in some cases, installment payments in others. So what have the buy now pay laters done? They've taken what is essentially a digital experience that we got used to in other forms and turned that into the buy now pay later product. So what was an old-fashioned solution, credit card payment, subsidized partly by the store, partly by the consumer, has become something much more digital, much easier, much faster, much more corresponding to what today's customers are looking for. And what that means is that they've become smart, and that's what retail needs to do. Retail needs to get smart in the same way as online commerce has been smart in the way that it sells things. And one of the reasons that online commerce has been smart is that and particularly when it came to payments, is they had a real problem with dropout. So they would get people going all the way through to checkout, and then at the last minute they didn't pay. And so they looked at what was happening on there. They said, how come I've got all these people, I'm paying all this money to bring them to my website, I'm getting them to really engage with me. They're looking, they want to buy, and then they get to the last point, and then they actually don't make the purchase. They drop out. Okay, some of them maybe they were just playing the game. They had never had any intention. But what they realized was that the payments journey, the way that they experienced payment at the end, was something which affected what they wanted to buy and how they bought it. And that's how buy now pay later came along. It made it very simple to make that extra conversion of a sale and to pay in installments. If you had to do what you did in the past, where you had to go through a credit check, you had to send in all your documents, and then you waited for approval, well, you're not going to be able to do that online. And the same is happening in store. So retail needs to get smart. And to get smart, let's go back to first principles to see what that means for payment. First thing is that retail commerce is all about selling. And when we sell something, when we pay for something, there's one thing that happens. We exchange something of one value for something of another value. So you buy a telephone and you give rupees. And the value, I'm not going to explain to you how money holds value, but it's the paper money is considered as something of value. So we give the currency to the shopkeeper to buy something, and they trust us. They know that the value of that money is worth something to them. In some places, we still give checks. In France, you can still go into a store, write on a piece of paper that you pay for something, and the shopkeeper will give you the good in return. So they trust you. They trust that signature at the end of a piece of paper is sufficient to allow you to allow them to give you the goods in return. Or we can use a card, we can use a phone, which is just another way of proving the payment. But at every point in the transaction, whether that's a Kirana here in Delhi, whether it's Louis Vuitton in Mumbai, they want to be sure that they're going to get paid. And that's what money does. The merchant holds it and the customer gets the goods. There's a trusting relationship between the two parts of the transaction to ensure that they're going to get paid. And that's why my slide is slightly messed up there. That's why brands matter. That's why Visa, MasterCard, Discover, PayPal, Amazon, Amex, all of these brands have invested in their brand image, because what they need to do is to reassure the customer that when somebody goes in with a Visa card or when somebody goes in with RuPay on their card, that they will be paid as a merchant for what happens. And that's why something like UPI is very interesting, because UPI is a technical infrastructure, and it's something which is really quite extraordinary from a payments point of view. What's been done here with UPI is really fabulous. It technically allows innovation, but then they're not a brand. They need they allow the payments to happen. But then it's up to the fintechs, it's up to the digital wallets to create their own brand, to create that trust for the merchant, to create the trust for the buyer that the merchant will be paid. And I want to insist on that, on the importance of branding and of building that brand confidence in payments for retail, not just for the issuers, but also for the merchants and for the customers. Because there's one thing that's important about that. And that's that the merchant is sure that they're going to get paid. And the other is that these digital wallets are about segmentation. They act as a way of identifying who the customer is. And that goes to the heart of what payments is about. If you pay in cash, you're one type of customer. If you pay with the American Express Platinum card, you're another type of customer. And that's valuable for the merchant, whether they're tier 1, whether they're a tier 3 type merchant. And that's why payments are becoming more and more, and the digital wallets are becoming more and more a segmentation and a marketing tool for retailers. So if we go back to what the very first credit card was Diners Club in New York in the 1950s. And Diners Club did something very basic in payments. It took a segment of the market, which was the New York businessman who had to pay for their business lunch. They took New York restaurants who were looking to capture that clientele, and they put the two together. And through their marketing, they created a brand awareness between their brand, Diners Club, a confidence with the merchant that when the businessman left and didn't hand over dollars at the end of their meal, but simply gave a credit card number, there was the confidence that at the end of the week or the month, the restaurant will be paid for that transaction. And that's what we need to get back to with digital wallets. So while the big players, they do it and they do it well, the smaller players and penetrating the market is going to be will come from that. So why today are some merchants are happy to pay high rates for transactions? It's because they're capturing new clientele. They're capturing a clientele that's specific to their business. So another anecdote on that: American Express in Europe had great difficulty getting restaurants to sign up for their card because it was too expensive. They were looking for merchant discount rates of 4 or 5%, way too expensive for the restaurant. But at the same time, the restaurant wanted to be able to put on their door the American Express blue box. Why? Because the blue box was a status thing. It says, I'm this type of restaurant. So payments as a form of segmentation. So Amex came up with this great idea, which was to say, we're going to charge an annual subscription fee. We don't charge you a percentage commission. We'll charge an annual fee for being part of our network. And at the end of the year, when they did the calculation as to how much on average these restaurants were paying, they were paying 8%, 9% commission for that business, and they had practically no churn. Restaurants kept keeping it. paying their annual subscription at what was turning out to be an 8%, 9% discount rate. Why? Because for a certain type of restaurant, getting that type of customer was important, and they were prepared to pay those sorts of rates. And I think that that's going to be the same thing with digital wallets. I think it's going to be. I'm not saying that they're necessarily going to pay more. I think one of the interesting things that's happening is that the fintechs, the new business models that are coming up with innovative ways of charging and of making money from payments. But the idea that payments will remain something of for segmenting the market, I think is here to stay. And that's why again, branding is important. And what we need to be very careful of is that nobody goes bust soon. Because there's one thing that will really cause a problem in this industry, and will bring the digital wallets into disrepute, is if they don't pay. So bringing in the collection, ensuring that the merchant is paid for the transaction, which is something that UPI does very well, is great. But it's something that we need to be very careful of. And they were talking about regulation earlier. I think that level of regulation to ensure that a payment can happen with trust at a merchant, and that the merchant is paid at the end of the day, it's in everybody's interest that there's some form of regulation to ensure that happens. And one of the ways that will happen is, and it's one of the complexities of the business today, is ensuring that there's some form of guarantee and notification at the point of sale that the transaction has occurred and that the transaction has been authorized. I've worked in the past on rolling out digital wallets in markets, and we always came up with this problem, which was when it's very small scale, it's not a problem. You can send an SMS that says payment has happened to the shop owner. But as soon as you start scaling that up, as soon as you start, for example, in restaurants where people are on day wages, people are moving from one place to the next. How do you make sure that the SMS goes to the right phone for the right transaction? So there has to be some form of notification that the transaction has been authorized, and some form of record that the transaction of record, so that the merchant can go back and say this transaction was authorized at this time, and I can therefore make a claim against the issuer to get paid. So the little piece of paper, the 5 inches or 4 inches of paper that come out of a terminal that say this payment was authorized for 200 rupees has got huge value. I think it'll be replaced. I don't think we'll always have pieces of paper. But today, if you can go into any store, and with that you're getting the same value with that piece of paper as you get when you transfer rupees or cash in the past. So how tomorrow are we going to notify the merchant that a payment has been authorized and that the transaction has really happened, and that therefore they have a claim against the issuer? I think this is one of the big issues for the industry. Everybody wants to be sure that they're going to get paid. So now that we get the basics right, we've brought in a system where digital wallets, payments, new payment methods can be authorized. What can happen after this? Well, firstly, I go back to what I said earlier. Customers want more. For a start, they want it to be simple. There are all sorts of ways that we can interact with the store. If it's too complicated, it won't happen. They want recognition. Loyalty programs, I think we'll be moving on to loyalty, I don't know if it's 2.0 or 3.0, but I think loyalty as and a much more sophisticated recognition of the customer is something which will be intimately tied into how they pay. Obviously, they want it faster, so the payment journey itself has got to be fast. Where before people queued, they don't want to queue. So can they do self-checkout? Can they pay? Can they scan and pay? They want more choice, so they want to be able to choose whether they pay in installments, whether they pay directly, They want to be able to choose how they pay. Something more personalized, so again, better offers, more adapted to them, specific to their consumption habits and to what they do, and then obviously more efficient and more than just product. Again, back to the idea that the in-store experience is got to be more than just a product. And that in-store experience will be one thing in a tier 1 store, it'll be something else in a tier 2, and it'll be something again in a tier 3. But all the way down, and this is something that we see everywhere. You see at all levels of commerce. You see that as it starts at the top, it moves down to the bottom. So you see already with the huge growth in digital payments and POS in smaller stores here in India, you see how something which started off as the preserve of the top stores has become something which is now more popular. So part of that is going to come from the part of that will come from the ecosystem. I presume you all know these sorts of charts where the ecosystem is mapped horizontally, vertically. I think what's interesting about that and where payments will change in terms of the in-store experience is that the horizontal will meet the vertical. In other words, the services that are specific to certain for a sector will interact with the payment into something that we call payment orchestration, which is the idea that you mix the payment journey at checkout with a service at checkout in order to achieve your business goals. And I'd like to show you a quick video of this, which is something that we put together. It's not to advertise what we do, but it shows how we see payments orchestration happening in the future, how payments and services can come together to create something that's different at the checkout, all with the aim of increasing business or driving business goals for the merchant.
Your customers are looking for flexible solutions on their payment terminals that will help them run their business. PPAAS gives you access to a catalogue of services that help you manage your merchants and their terminals, and your merchants manage their business while securing and growing their revenues. We offer a comprehensive set of API-driven, cloud-based services. Device management for acquirers, cost-effective payment methods and solutions for acquirers and their merchants, and access to a broad range of commerce services, which combined go to make up the payments ecosystem. PPAAS is continuously onboarding the catalogue of commerce services merchants need. Payment orchestration is about combining payments and services, so businesses can create compelling customer experiences and generate new revenue streams at the point of sale. But different businesses need different combinations of payments and services, or want them to flow in a particular order to suit the way they work. By orchestrating services with payments at checkout, merchants get to design what the customer experience is in-store, just like for e-commerce. Here's how it works. Acquirers or aggregators have access to a variety of traditional and alternative payment methods, as well as a suite of commerce services from selected solution providers. Traditionally, combining these was complex, often requiring lengthy development and certification. PPAAS makes it possible to build customized checkout journeys quickly and easily. Payment providers decide whether they want to orchestrate the services themselves or let their merchants build their own checkout workflows. Once the commercial agreements are in place, the merchant chooses which services they want to include on the payment journey and whether they want it to occur before or after the payment itself. And they can make the orchestration subject to certain rules, like not proposing the same service to the same customer twice in the same day. And combinations can be saved as templates, making it easy to apply the same journey to stores from the same chain or to other merchants wanting the same checkout experience. Once the payments and services have been combined, it's just a matter of updating the terminal using the cloud-based services. When customers come to pay, services will appear just the way they've been configured. Payment orchestration creates opportunities to interact with customers at the moment they pay, so merchants can maximize the value they get from the additional services they provide, improving the customer experience. And they get to pay with whatever payment method or combination of methods they want. Once payment has been authorized, there's the opportunity to interact again and capture valuable payment authenticated data. PPAAS brings the power of the payments and commerce ecosystems together, delivering what merchants need to differentiate and grow their business. With payments orchestration, PPAAS turns payments from transactions to interactions. It really is as simple as that. PPAAS, making access to the payments ecosystem easy for everyone.
Thank you. So to wrap up, because I think we're running short on time. In what I wanted to show there with that was not just what PPAAS is doing, but even though that's it's at the cutting edge of what's happening. What I think is interesting there is that the last line where we talked that we move from transaction to interaction. In other words, how the customer interacts with the store at the moment of payment is going to become more and more important. That interaction, when we pay for something, it's never the nicest moment when you have to actually, you've had a nice time in the store, you buy something, and then you've got to take out your card and you've got to pay for it. You've got to pay for it, so you're taking money from your bank account. So how do we make that something which is pleasant, which becomes something which is memorable, which is something in which which contributes to the merchant's relationship with the customer, is something which I think payments will really help in doing. For tier 1 stores, we believe that will come from omnichannel. So tokenization, the ability to recognize the customer as they move across the different touch points, because for the bigger purchases, people are looking more and more online, going in store, maybe to make the purchase, but maybe pre-ordering online. So how do we use their card and tokenize that card in a way that we can that it becomes actually the identifier of the customer? So that's something more for the bigger chains who are able to do that and able to come up with an omni-channel offering. For the smaller stores, payments I think can be used to do 3 things. They can be used to secure their existing revenue line. So how do I use that payment relationship to capture more of that business and make sure more of that business comes to me as a merchant? It can be used to grow. So they talked on the panel earlier about buy now, pay later as a tool of macroeconomic policy, as a way of actually expanding the consumption in the market. Again, needs to be regulated, but buy now, pay later, all that ability to grow my business from my existing customers, and then to create. So we talked a lot in the past few days about how the POS can be used with an authentication device to do a micro ATM. So that's a huge new business for stores. If a store can all of a sudden turn itself into what's basically was the preserve of the banks, then that's something that they can make money out of, and they can use that to create new revenues. So payments will become something which are auto generating in terms of revenues. So what next? What are the next? The last to wrap up. I'm not trying to be futurist. We had a conversation last night with friends about how what was going to happen in payments and what was realistic in the short term. Payments move slowly. Traditionally, payments have always moved very slowly. The first thing I'd say is that slowness is accelerating. What was taking 6 months in the past is taking 2 months now. What was taking 3 months is happening in a month. That's the level of speed. We're not at the sort of speed that you get in some industries where, you know, a product can be launched in 6 weeks. It's not as quick as that. There's legacy infrastructure there that's going to have to change. But there's a lot of things happening and that can happen around payments that will change things in the short term. And I think that's where merchants need to be clued into that and to realize that it's in their interest to move with the times and to move with those points. So thank you very much for your attention. I don't know if we have any time for questions. No time for questions. But I'll be around. I'll be on my booth. So you're more than welcome. Thank you very much. Thank you.